Hello Apex entrepreneurs and welcome to this video. Now let's move on to the last ratio we're going to look at today, which is the debt-equity ratio. This one's nice and simple. All we have to do is divide the debt by the shareholders' equity. The lower the debt-to-equity ratio, the better it is. Higher DE ratios tend to indicate a company or stock with higher risk to shareholders. Any DE ratio greater than 2 is considered too risky. For Facebook, the DE ratio is equal to 0.1, which is great. For Google, it's even better at 0.07. In order to value a stock and decide whether to buy or not, you have to examine all of the ratios that we have seen. Also, always remember to compare the numbers of a company to its competitors in the same industry, and not to the average S&P 500 numbers. We should also take note that in the last couple of years, we were and still are in a bull market. The majority of stocks are currently overvalued, so it is difficult to find an interesting company to invest in. In a bull market, it's difficult to find value. But in a bear market, you can find a lot of undervalued companies to buy. You should also note that all of these methods might not be efficient in valuing disruptive, high-growth companies like Tesla, for example. Tesla has actually been losing money for the last decade. So if we apply the ratios we have seen in this video, we might conclude that it's very overvalued. But what if Tesla one day succeeded in getting a dominant market share in the automotive industry? Then its share price could potentially surpass $2,000. So when you evaluate growth companies, you should always take into consideration a lot of factors other than just the ratios.